All right, well, Larry, I mean, I guess obviously the obvious question is here. Markets are definitely talking. I'm listening. What are they telling us? We got tariffs. We've got gold going through the roof. We got the Magnificent Seven trade just getting crushed right now. How are you reading the tea leaves, or what is the market telling you when it's talking?
Well, there's two things. Number one, the market was already like on a lot of tension because of the $1 trillion deficit in the first quarter, and that's Trump and Biden. A lot of it's Biden, and then the large deficit last year. So the global investment community was already like, "Oh my God, this is really crazy fiscal uncertainty in the United States, and how are they going to refinance it?" So that was the whole picture going in. And then Trump just hit it with a sledgehammer and made that uncertainty even worse. But at the end of the day, here's some really important thing that's going on with this huge rotation. So in 2022, we had an inflation scare. And what happened was the Fed hiked rates, and then into the election, they over advertised inflation control in the Biden team. And you don't blame them. Okay. Trump would have done the same thing. Any White House would have done the same thing. So you had this entire intelligentsia in Washington that was basically saying inflation's dead, it's going back to 2%. And so if you're a global asset manager, the old DCF models, we talk about this in the book, right? How does the market speak? There's a chapter where we talk about the DCF model, discounted cash flow. And all that means in simple terms is that if you're a financials analyst that's analyzing companies, and that risk-free rate, which is your 10-year treasury, your 5-year treasury, if that's at an elevated level for an extended period of time, then you need to own different types of companies. If the DCF, if the risk-free rate is low, that makes software companies worth a lot more, or growth. That's the way we had it from 2010 to 2020. You had a very certain disinflationary period with a very low risk-free rate. And guess what? Trillions of dollars moved into growth, into software, and all types of companies that don't really own any hard assets. Now, if you move into a regime where there's elevated inflation, tariffs, multipolar world with a higher risk-free rate, that DCF model that all the Wall Street banks use, it basically starts to calibrate, and you need a whole new portfolio construction for that higher risk-free rate. And so that's a big part of what's going on now too. So companies like your BHPs, your Newmonts, your Freeports, companies that own assets in the ground, they're going to give you a lot more protection in a sustained rates inflation world.
Well, I like your thoughts on hard assets. I mean, commodities are definitely a component of our portfolio. And this year, commodities are really one of the only asset classes that are actually working right now, given all the turmoil that we're seeing in the markets.
Well, you think about it, as long as there's not a Lehman event, there was 27 trillion in the NASDAQ 100 on February 19th, 27 trillion. Now there's about 22 trillion. So 5 trillion moved into other places. So as long as there's not a crash where correlation goes to 1 in like a Lehman scenario or a COVID scenario, then there's just this a beautiful, absolutely beautiful migration rotation. And that's kind of what's going on now.
I kind of agree with you there, Larry, because you look at the level of pessimism. The Economist just came out with 3 negative covers, and the old magazine cover. And there's not that many magazines left, so we don't have that indicator like we used to in the 70s and 80s.
But they're the best of all time. I mean,
They really
if
are.
all you ever did was go against the Economist, you remember being a billionaire.
Yeah, exactly. Yeah, I think if you don't have a great financial crisis situation, I don't think all this pessimism's deserved right now. I mean, I don't think there's the market reflects the negativity that we see, through all the different indicators.
And there's certain sectors that have already been through a horrific crash. The biotechs. I mean, if you look at the XBI or any of the biotech ETFs, a lot of the companies are trading at cash value.
Wow.
Cash. I mean,
Yeah.
and so we run a Bloomberg chat behind us with hedge funds, mutual funds, and pension funds. And over the years, we've been able to build trust with a lot of PMs. One of the guys made a great point today. The Trump team just made a shift on biotechs at the FDA, and they're basically looking at artificial intelligence and really powering and really kind of bringing that artificial intelligence into the not the clinical trial process, which that's the holy grail of biotech, but all the legal and all of that other infrastructure in creating drugs can be massively augmented. And now the Trump administration's behind it, and you've got this AI, you've got that essentially really cheap stocks that have tremendous potential, and they're really washed out. And so within the market, there's different parts in the market that are much cheaper than others, and there's parts in the market that have already gone through a crash.
And I find that really interesting because we talked a lot about, last year and early this year, everybody was excited with the Trump administration because it was likely going to be less regulation. And when you bring up the healthcare industry, that is easily one that should benefit from that and should benefit from AI, which was the big story. But now tariffs have just taken over the narrative and people have just thrown that by the wayside. But I don't know if that's really gone away yet. So I think you bring up a good point. Like, have we just lost the idea that that is going to improve earnings down the line, that at some point in time is going to come back into the headlines, and people have just thrown it by the wayside and aren't factoring it into earnings any longer?
Exactly. And it's the same with copper, uranium, coal. Take copper, for example. You've got artificial intelligence, the U.S. power grid. When we were talking about in the book, we talked about in our book, When Markets Speak, the U.S. power grid essentially needs a $2 trillion rebuild. You're trying to put artificial intelligence steroids on like a skinny, broken down 90-year-old man. That's the situation. I mean, this is nuts. It's absolutely nuts. Like if you believe Jensen and all his, whenever he gets up on stage, by the way, look out. The stock drops 20% because he's the pump master. Nobody's better than this guy, right? Meanwhile, all you should be doing is buying copper companies, because if Jensen is 50% correct in NVIDIA's sales pitch, the copper stocks over the next 5 to 10 years are up 300 to 500 to maybe 1,000%.
Well, that brings another question too. I mean, we're spending so much money on artificial intelligence infrastructure, and it seems to me like we need real infrastructure, right? It's almost like all this capital is being spent in the same place for perceived demand that we don't know if we really, really have. And I actually saw I don't know if this is true or not, but they say that something like 47% of NVIDIA's revenue is really just going to China, whether it's going through Cambodia or Vietnam. So I just wonder, if all this demand all this money we're putting into this AI infrastructure, should that be going into real infrastructure like the power grid, like you just mentioned?
Yeah, exactly. Well, what happens is it's just like the dot-com. If you lived through the dot-com era, we were lucky enough, my partner and I, Steve, my business partner, we created convertbond.com in the 90s, and we sold it to Morgan Stanley in October of 99. That was probably the best trade I've ever done.
And then you put everything into AOL stock. Just kidding.
Yeah. Well, but the thing was, everybody wanted to be long Global Cross, like everybody wanted to be long JDS Uniface, and nobody was really looking at like Match.com or things like Facebook or all these companies that would monetize the incredible infrastructure. So it's the same thing where you want to kind of like over the next couple of years, you want to look at, okay, AI, but also like who's going to really benefit from what companies are going to become the most profitable ever because of AI.
Well, guys, you can go out and you can buy Microsoft right now, and which was a $3 trillion market cap, or you can buy the entire German stock market at a $2 trillion market cap. So, Microsoft spending all the money. I think some German companies may benefit, from AI. And so I think it's just, I think the U.S. market just became so overvalued, as you said, Larry, over the last 15 years. We've dominated. Our GDP's been greater. Our investment's been greater. At some point, valuations matter.
Well, every company in the URNM, which is the uranium ETF, I think if you add up all the value of all the companies, it's only like $44 billion. I mean, what is that, a bathroom in NVIDIA or something like that? I mean, this is not. So in other words, here's what I've noticed about what you guys were just talking about. I love the angle around, the Trump trades got so priced in what I call the tourists getting off the bus, in December. Imagine the overweight gentleman with the tie and the camera. They're all tourists that really, these aren't real investors. It's hot money. They're chasers, and they got long uranium stocks. They got long a lot of these coal stocks. And then, like you said, income tariffs, in comes a narrative change. And what happens is it's just like a poker game. The real money stays in, but the fluffy money goes. And it's the same thing with what just happened. So all the tourists have been washed out. You can buy the SRUUF ETF, which is a uranium ETF. You can buy a lot of these NUKZ, which is a wonderful portfolio. These things are all down 30, 40, 50%. And guess what? The other backstory was the Kazakhstan government. If you imagine a scene from The Sopranos, right? After the war, so it's not just tariffs with uranium, it's tariffs and that's shocked, but also if the war unwinds in the Ukraine, guess what? Putin's got bills to pay, right? And what does Tony Soprano do when he has bills to pay, the famous Sopranos? He goes around to his surrogates, puts up the gun and says, hey, we got to make a deposit. So in other words, and that's what he just did. He shook down the Kazakhstanians, right? Kazakhstan country. And so all of that created forced selling in the uranium space. All of these power plants in the United States that were going to be beautiful contract buyers, they saw this seller come in Kazakhstan. They stepped away, and that's where you just had this elevator shaft drop in some of the uranium names. I think that's a great place to be for artificial intelligence for the next 5 years.
Yeah, and I think we're also seeing that like from the retail level, the amount of clients who are calling us and in a panic right now, just hearing what's happening on the news. The last couple of weeks, we've had a lot of that. And you're also seeing that. You're seeing a lot of the retail investors are starting to actually sell their investments, which contrarily can actually be a good sign, the fact that people are nervous. So, hopefully we're getting closer to an end of this. But, I think you're seeing that not just on investor levels, but on CEOs, kind of across the board. Everyone's just uncertain and they don't know where to go. But it's usually probably the best time you want to start to allocate your money in, because those big up days tend to happen right around the worst days in the markets. And this is good to remember as an investor, is when things are the most nervous, probably when your best buying opportunities.
Absolutely. I mean, J.P. Morgan, 1907, he said, there's nothing in this world which will so violently distort a man's judgment more than the sight of his neighbor getting rich, right? and so everybody that was like the January, February thing. And now you have all of that hot money flush in the middle of a new bull market in uranium, a new bull market in copper, a new bull market in so many different sectors, biotechs. And you just have this like massive crisis, which creates an opportunity.
So I guess the big question, Larry, is where are the tourists going next?
Exactly. They'll be back. Right now the tourists, whenever the VIX is 30 or more, there aren't any tourists around right now. They're hiding under the sheets, but they'll be back. They'll be back. I think there's a lot of money moving into EM, right? So that's probably, I would think that would be the first area where they would go. Brazil's been massively underowned. There's an election next year. Lula is literally a Biden type situation, really old, done a horrible job. If you get a market friendly candidate in Brazil next year, and remember, one of the at our ideas dinner last week, one of the clients made this great point. He's like, if you see Milei, right, in Argentina, and you look at that Argentina equities, and you look at the Trump trade, at least at the beginning, not now, but people think like they want to get out in front of these elections, right? So even though the Brazil elections next year, people are going to be probably front running that. And then with the weaker dollar, that's where you get stocks like Brazil are trading at 12, 13 times earnings versus right now the S&P is potentially at 25, 26 times earnings based on the earnings coming down relative to where stocks are now.
And the dividends are better.
Yeah. And a lot of Valet. I mean, you can buy Valet with I think the free cash flow yield, Valet, VALE equity, big mining company, 10% free cash flow yield, almost I think a huge dividend as well. I think maybe 6-7%.
I guess the big question is, and I don't know what your feeling is on this, but it looks to me like China may have bottomed, and a Chinese recovery really that benefits commodity-based economies like Brazil in a big way, correct? I mean, do you see that as part of the trend here? Is China bottoming and China actually recovering here? Assuming they're not going to pay 150% tariffs in the U.S. or whatever. Yeah.
So we're back to the street again. So in the last couple of years, there's been 2 times where the street said that China was uninvestable. And from that moment, China stocks were up 100%. So whenever the streets start to talk about delisting again, but remember, if you delist China equities, it's much more damaging to U.S. investors than it is to the rest of the world. And so, yeah, sure, it's just a tactic that Trump is going to use. I don't blame him, on negotiation, and the Trump team's threatening to delist these companies. But in the end, they'll do a deal with China. They have to do a deal with China. And so you want to buy that fear. And remember, the one thing about Trump is he creates these great capitulations. Mexican equities in 2016, there was a Hall of Fame capitulation in the peso and EWW. And then, a year and a half, 2 years later, you were up a lot. And so the Trump, pounding the chest, the Trump bravado, the Trump intimidation, those games. And don't forget, the media will overplay that, right? They hate the man. Okay, it's okay. Some people like him. Some people like Trump. Some people hate Trump. But let's call a spade a spade. The media will embellish the fear over and over again, and they will scare investors, and it creates opportunities. It's a fact.
But I guess what I can't get my arms around is long-term rates continue to go up, right? I mean, it's like if the economy is presumably slowing and we're seeing inflation come down, why is the 10-year inching up around 4.4%? And I guess the question is 5% is normal interest rates. Do we go back to normal interest rates? Is that signaling that economic growth is actually going to be pretty good, right? And because, if we have stronger economic growth, then that would justify having higher interest rates, especially on the 10-year, which right now just doesn't seem to jive with what's going on in the market and the view of the economy.
Yes. So the point we make in the book, How to Listen to Market Speak, is that
I'm listening, Larry.
In a multipolar world.
What does multipolar world mean? Yeah.
Okay, so a unipolar world, let's go from the last 20 years are basically unipolar, where the United States is the global central world power. Supply chains are moving smooth as silk, and global conflicts are relatively contained. And globalization as a whole is working with a lot of smooth gears. A multipolar world is like 1968 to 81, coming out of the Vietnam War, all kinds of trade and OPEC and all kinds of problems in the Middle East in terms of oil, and really a crisis globally where there's not one global power that's in control of things. It's more like a multipolar world where a lot of different countries are either in conflict. Now we have 2 wars, but there's all this conflict with Trump and Europe. And so then if you're a bond investor, you're like, oh my God, the U.S. just took their deficit from 2 to 3% of annual GDP to 7%. And they need the global investment community more than ever to buy the bonds. And so if you're a global investor, like you're table max long equities and bonds, you're long essentially what we call financial assets, paper certificates, you're going to be like, if you look at China, you look at Japan, they've sold down some treasuries in recent years, and all of that creates animosity and insecurity, and that's why typically, like you said, let me give you an example. When Lehman failed, the market lost $8.5 trillion, but you made $3.5 trillion back on the bond side, right? 3.5. When COVID went down, we lost $9 trillion. When COVID went down, or COVID happened in 2020, you made $4 trillion back on the bond side. Here, we've lost $9 trillion in this drawdown, and bonds gave you nothing back. That is creating a lot of real tension in the White House, and that's probably why Trump has to cave at some point soon and start doing some deals.
Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, brokerage product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review.
So I guess the big question is, when does that happen?
Well, JD Vance is trying to say he did something with India last night, but I think sometime in the next 3, 4, 5 weeks. Remember, the midterms are out in 26 in November. You got to really get these games out of the way by, I would say, September, October, November, a year from the midterms to try to, because remember, if Trump's impeached, if Trump loses the midterms, he's going to be impeached again, right? There's no point. It's guaranteed, right? So they know that. And, one of the things, I was talking to Nigel Farage in December, and he really helped because he sees his buddies with Trump. And he said, Larry, they want to take the pain as far away from the midterms as possible, right? That's what the Trump people were saying behind the scenes. And it's like, all that means is tariff stuff, anything you need to do in terms of, oil, anything you need to do in terms of maybe even, cutting spending and austerity, all that stuff has to be far away from the midterms. And then you can try to stimulate the economy through tax cuts into the midterms.
I understand that. I agree with that. But is that part of Trump's, chaos theory? Just create as much chaos as you can instead of having, Besson, who's just one of the smartest guys on the planet, be the voice of the administration. He comes out and talks, and then Ludnick's out the next day, and then Trump's out on social media the next day. Maybe that's part of their strategy. I don't know.
No, there's no question. Trump thinks that he wants to use chaos theory, but he's not thinking about the leverage buildup just on the government side. We went 3% deficit to 7% deficit. And then if you look at all the leverage in credit, and if you look at all the leverage in equities, so there's all of these unintended consequences that chaos theory works okay with much less leverage in the system. But at the end of the day, the beasts in the market, the serpent in the market, essentially body slammed the Trump team, what was it, 10, 15 days ago.
That 10-year treasury spooked him for sure.
Yeah,
I think they said Ludnick and Besson took him into a room and said, dude, you got to put a delay on these tariffs like immediately, while Peter Navarro was like in another room. They're just trying to keep him away from Peter Navarro, is I think they said in the Journal. But I also wonder about, talking about liquidity, and what kind of I find odd right now is, why is Bitcoin going higher? To me, that seems like that's the ultimate litmus test of where speculation is, unless, and maybe you believe it's the next currency we're going to use, but it seems to me like that's the ultimate casino. And until that breaks, you don't really have a liquidity problem. I think that's like the best litmus test that I can possibly think of.
Brian, you're spot on. Like you're essentially, we make the point in the book. The long Bitcoin trade for the last 10, 15 years has essentially been long excess liquidity, right? So if you had excess liquidity, you do great. But until now, the whole fiat BS and all of the, independent money and you want
bullshit marketing scheme they have on why
it's all true, but all BS in the sense that your price action's just liquidity driven, right? But what's happening now is, because the dollar is weakening so fast, because we had bonds, stocks, and the dollar all go down together in the same 3 or 4 or 5, 10-day period, that all it takes for global central banks is a very small portion of that capital to make its way to Bitcoin. And so for the first time, Bitcoin is actually not responding. Like, for the BIX to be 30 to 33 and Bitcoin up the last couple of weeks, that has never happened before, according to all of our models, maybe for like 5 or 10 minutes period. Just look at August, right? In August, you had this like liquidity crisis around the Bank of Japan and the carry trade. And in 4 days, Bitcoin was off 30% because of liquidity. And the whole narrative of fiat and all that stuff and, independent finance, all of that goes out the window when liquidity dries up. But for some reason now, because I think we have this global crisis with the dollar and with confidence in the White House, for the first time, we're seeing Bitcoin do its job, which is a wonderful thing. And you could also say there's a maturity level in the market after the ETFs. And what I've been worrying about Bitcoin, and maybe you guys can correct me, but if you really dig in there, there's about 30 or 40 families, maybe 60, 70 people that control 50%, 40% of Bitcoin, right? And so if one of those families has a liquidity event and comes to the market to sell it, they're going to just hammer it down. Gold's a $16 trillion market. And it's literally its largest drawdown from gold the last 10 years is 22%. The largest drawdown. Bitcoin's had 3 drawdowns of 70 to 80%. And that's because of that liquidity issue. And so it's just a very immature market relative to a mature market with gold.
Yeah, which may or may not be around in 10 years. Who knows? Your guess is as good as mine. But I think that also speaks to that liquidity hasn't necessarily gone away. It's really more just the fear of what could happen with tariffs, what could happen to the economy, it seems to me. It still seems like the world's awash in cash. Like, you're talking about private equity, how much money are they sitting on to do deals? And, we look at those money market fund numbers every week. It's like up to like $7 trillion. And then you add up like the short-term CDs that are out there. So it just seems to me like, liquidity is still not an issue, even with this shakeup going on right now on Capitol Hill.
Right. And so interest rates have been so high this cycle that, like you said, they brought that $7 trillion into money market funds. And so it's different than previous cycles when you're at zero interest rates. And yet you've got more cash on the sidelines.
Yeah, I guess the big question is, what does it take to get that cash back into the market?
The oldest boomers are turning 79, right? And they control 79 trillion of wealth. So 10 years ago, the oldest boomers were turning 69. So when Lehman went down, they were probably 65. And so now the oldest boomers, and that's if you were born, I think, from 1962, from let's say 42 to 62, somewhere in there. So the boomers control 19 trillion of wealth. They're turning 79. And so therefore, they're going to want to own more bonds or more safe assets relative to stocks. And so that's part of, I think, what's going on with this rotation into cash. But, then you have on the other side of the coin, the youngsters, the millennials control 7 trillion of wealth. And that money eventually is going to come from inheritance down to the millennials. So it's going to take some time. So there's this whole process of that. But at the end of the day, we're in the early stages of just a bear market. So we have lower highs for the S&P because everybody's crowded into the S&P. So the earnings in the S&P, the Street is looking for 270. We think damage has caused earnings down at 230. That's the more realistic number. So if you're 230 times 18, that's a 4,200 number. And so the S&P is still up, well above 5,000. And so the market has to digest that for the market itself. But within the market, there's, like I said before, there's other parts of the market that have already crashed, and they're not exposed to this passive unwind that could come from the boomers. Now, remember, the boomers are turning 70, 79, the oldest ones, and if they're selling out of passive ETFs like the S&P or the NASDAQ, then that's going to basically create like a 3 or 4, maybe 1 or 2 year period because of where the VIX is, because of all this tension where people are moving out of the index and into other things like commodities.
People have been talking about that for years now, but I think the question is, when does that happen? But I think that also plays a lot into the housing market, right? There's this huge housing shortage that's happening, but baby boomers are not wanting to sell their big houses. They're sitting with either no mortgage or really low mortgages. And now you have the millennials who want to buy these either starter homes or family homes, and they're not around any longer, which is why the home builders are really trying to keep up with that. But how do you see that playing in? Like, is the baby boom consumer is also part of this huge shortage that we're seeing in the housing market? And is that also going to take years for this to actually fix the problem for some of those houses to come on the market?
Yeah, exactly. So that's the Trump team who knows that they have a huge housing problem, inequality, like in terms of the amount of income it takes to get into a house. And to your point, it's like rates are so high, who would want to sell their home? So you've got this natural problem, and that's like this brewing crisis. And then you have this uh the situation with the student loans. And so that tells you that there's a problem there, whether it be, pay me now, pay me later, lending like a firm, or all these other vehicles that were used to support subprime lending, and that's something I think we want to pay attention to, because it speaks to a credit problem that's developing.
I saw, this is on social media, so this, I don't even know if this was true, but it was talking about Coachella, which is, a big music festival out in California, and how there's a much higher percentage of people who bought their tickets this year on credit cards or pay now, pay later, which I just thought was like an interesting kind of microcosm of like, is that happening in the economy? Which is exactly what you're pointing out.
Yeah. Another reason why they can't play around the bond market, because every time the 10-year goes up, that's going to add to the interest expense on the debt. So it's a really tenuous situation when you think about it. And to your point, we got to figure this tariff situation out like yesterday, because how many? I think the stat I've seen on this is the average business in America has 15% margins. So you add enough tariffs on there, you swing from $1 million profit to $1 million loss like that. And I think that's what a lot of businesses are seeing right now if this doesn't get rectified, because they don't know what their input costs are. And instead of saying, this is what the new tariffs are going to be, is what it's going to be, it's like, we'll delay it for 90 days, whatever, but then it's going to be something else. And businesses can't make decisions, and they have to make decisions long-term on the short-term thinking. I think it's really problematic. And the president's lost a lot of goodwill over this kind of shock and awe strategy that they're deploying right now. It doesn't make a lot of sense for the average business, owner in America.
Right. Confidence is everything for business owners.
Obviously, the person that needs to hear this podcast right now is the Trump administration, because it's clear nobody wants this new world disorder, right? We want at least some certainty. A markets rise on uncertainty, but we want some certainty that you can move forward. If you're, like if you're a CFO, forget about doing your job right now. How do you know how to spend a dime? So, you think people are weighing in heavily to Trump, or is he actually listening? What are your feelings about that?
At the end of the day, Republicans and Democrats drove 5 million jobs, and this is this scene in our book. Our book is about the J.D. Vance story and the middle class America, and really the hollowing out of that. Now, we took those 5 million jobs, we sent them around the world. We raised the standard of living dramatically in Bangladesh, Vietnam, China, India, which is a good thing. But we still have a base in the United States that's been hollowed out. And what did we do for these people? I mean, Democrats and Republicans, we created an opioid crisis where life expectancy in the Rust Belt is crashing. So neither party has really helped this group, and that's why this group has run to Trump. I'm not saying Trump has the end-all solution, but in his mind, at least right now, he's going to try to. It's almost like putting a billboard up on the highway. He's going to try to say, "Listen, we're doing this for you, and this is our goal." He knows that we really can't make Nike sneakers and underwear in the United States anymore. I mean, come on, right? It's crazy. But in the end, what they'll probably do, this is what I hear, it's if you just focus on, say, semiconductors and national security, and you give the golden visas to the most talented technicians in the technology space in Taiwan, and bring some talent over here and start, producing national security type jobs that will protect the country. If you just focused on that, that's the right thing to do. Right now, he's shotgunning it. He's over in aluminum and all these spots that just make no sense, right, on the global sphere. But I think he just wants to put a billboard up on the highway and saying, "Listen, I get elected. I'm doing this for you." And it's once again, it's definitely deceiving, just like all politicians are fairly deceptive.
Larry, so off the topic of economics and stock markets and capital markets. So Well, you can think about one album or song that when you heard it for the first time in your younger days and it changed your whole view of the world. What song or album is that?
Say song or album. I would say U2, Joshua Tree.
Hey,
You're looking at things from a different perspective, and the deep thinking that kind of brought into my generation.
how old were you when that came out?
I think I was about 18, 17,
Perfect.
18.
Best track on Joshua Tree.
Oh God, I mean, you got to go back a long way now.
All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob. Gross domestic product in the heartland states grew at an average rate of 2.75% over the past 3 years, exceeding the GDP growth of 2.68% for the states outside of the middle of the country. This marked the first time since the 70s that the nation's midsection generated greater economic momentum than coastal and other regions. Bipartisan legislation funneled trillions of dollars into the region in recent years via the CHIPS Act, the Infrastructure Investment Act, Jobs Act, and Inflation Reduction Act, all of which helped attract new employers and spurred growth. Who knew the Midwest was having this big boom, Bob? I've never gone to the middle of the country. I don't even know what it looks like.
Yeah, you do. You fly over it all the time when you're going to, coast to coast, right? Come on, that flyover country, beautiful country. But with the deglobalization that's going on, that always makes sense. The United States doesn't make anything, right? Look at what are you wearing right now? Nothing you're wearing was made anywhere near this country, but we're going to have to start building our infrastructure, and no better place to do it than, in the middle of the country. I mean, tons of companies are moving out of the coastal areas into Texas and the rest of the Midwest. So it makes a lot of sense. It makes tremendous sense. The investment dollars are there and the opportunities are there, right? And you know how America works. They find a need and they fill it.
All right, Chris, this is a special stat for you. The numbers keep growing. In 2020, 354 mega yachts were delivered to buyers, according to the Boat International. By 2024, the number had climbed to 520. Man, oh man, the world is, it's awash in mega yachts. Where's your mega yacht? I thought you were there.
Finally, after 5 years of doing this podcast, I get a boat stat. Man. So I mean, mega yachts, you think about what they cost, they're probably about a couple $100 million to buy them up front, but it's the annual cost that gets you. It's usually about 5 to 10% of whatever the purchase cost is. So, in a sense, a mega yacht's kind of a business in itself because you got to pay crew, you got to pay for maintenance. Not a great for the owner, but definitely.
So
great
you're not
going to
give your catamaran anytime soon for a mega yacht, is what you're saying.
I mean, it depends on I get that raise, that Christmas bonus I've been hoping for. Last year's Jelly of the Month Club was great, but I think maybe some cash this year would be nice.
Definitely a model of a yacht. You could afford that based on your Christmas bonus. So there you go. Keep dreaming, buddy. All right, Courtney. Volatility and uncertainty fueled a 12% drop in global art sales last year, led by fewer purchases of the priciest works. Per the 2025 Art Basel and UBS Global Art Market Report, the drop to $57.5 billion in 2024 follows a 4% decline in 2023. What's going on with the art market? Are just rich people not buying anything anymore? What's going on?
Well, I think this is funny because do you guys remember the headlines last year that there was a piece of art which was just a banana that was taped to the wall and that sold for over like $6 million or something, which is amazing because the banana was real, right? So you just have to keep putting up a new banana because it's going to get rotten. And
I think they actually ate the banana, right?
I think so, yeah. Which is crazy. So the headlines are not showing the stats that you're saying, which I think is interesting. But the reality is you have this wealth effect where what happens is when the stock markets are down or people are nervous about the economy, they're not making as many big purchases, and something like art is an easy thing to pull back on. So even if your consumer may not be in bad shape, they're also saying, I don't need to make a big purchase like that right now.
But so this is from 2024. So last year was a good year in the stock market, but also watches, I know as well, like other collectibles, the prices are down too. So I don't know, Bob, what are your thoughts on that? Why aren't the wealthy spending?
I'm watching this new series, and what's it called? Neighbors and Friends and Neighbors, and he's John Hamm is out stealing those high-end watches, and they're telling me they're worth $285,000 for a watch. I don't know. I'll stick with my phone, I
Yeah,
think.
maybe the perception has become a little less real in the last.
Yes.
Which is the amazing thing about art and collectibles, right? You create the right perception. You have to. I think an art dealer is probably the greatest salesperson in the world. When you think about it, you're creating the ultimate illusion. Like, go to a modern art museum, and you'll really see, like, what am I looking at right now?
How much of that is a shift in the trend, though, where especially your younger consumers want to spend on travel and experiences more so than, a piece of art or a watch? I don't know how much that plays into it.
It probably plays a lot into it, right? It just depends on, right? Just we're talking about, like, the younger generation's not drinking anymore. Yeah. So they do nothing fun, right? Yeah. They don't collect art. They don't drink. In the 80s, it was the opposite. I mean, you bought all the I think about Wall Street and, like, all the horrible art that Gordon Gekko had bought. And I mean, Gordon Gekko was always drinking and having a good time. So, Bob, the 80s were the best, hands down.
Yeah, right. The good old days. I'm always thinking about the good old days. Like back in the Depression when everybody was living on the street. The good old days.
I don't know. I think driving a Jaguar in the 80s with your comb in the side pocket.
Don't forget about the double-breasted suit.
Double-breasted suit.
Nice.
From an Italian suit maker with your portable phone. You kind of made it.
Hey, I put Xenia on the map. I'm still waiting for my override.
Hey, hope you enjoyed episode 201. Yes, 201, Payne Points of Wealth. If you love our podcast, you like our podcast, you love it, please give us that 5-star ratings. If this is on iTunes, on Spotify, you can like this episode. If you're watching this on YouTube right now, subscribe to our channel. But please don't keep us a secret. Spread the good word. Your support helps us to continue to do this podcast. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.